Imagine if you were designing a trading strategy based on the movie Inception, but instead of a dream within a dream, you create an indicator of an indicator. That, basically, is the Stochastic RSI. It's the Leonardo DiCaprio version of a trading indicator. Stochastic RSI takes the standard stochastic oscillator and, instead of basing a reading on the price in the market, it instead uses the RSI value, which itself is based on price. So maybe a better analogy than Inception is that using the Stochastic RSI is a little like marrying your first cousin. Seriously though, because the Stochastic RSI uses the relative strength index for its data, it essentially magnifies the swings of the underlying RSI with the hope of earlier signals and maybe better entries and exits. This, of course, is a double-edged sword, as it also magnifies false signals by the same amount. That said, many people still find it helpful when used in combination with other indicators that filter out many of the bad signals and hopefully leave a healthy number of good ones. Today we're testing a stochastic RSI pullback strategy from the excellent YouTube channel Trade Pro that was essentially the highest profit strategy that had a reasonable number of signals, which is a pretty good ranking since he had already tested 94 strategies on his channel at that time. Eric over at Trade Pro got a 58% win rate and a 74% gain on the account after testing 100 signals, though he did only use a single market and a single 15-minute time frame. To his credit, he does strongly caution that this may not be representative of a larger sample or different time frames. That's where we come in here at Chartie's Trading Lab. We manually backtest every strategy using the same rules, testing 200 signals, 6 different markets, and 6 different time frames, all chosen by a randomizing spreadsheet. But will that great performance hold up under our rules? Let's put it to the test today using these rules and see how it performs. The way we test all our strategies is on the screen now. Pause if you want to read. In the description box below, you'll find a link to Eric's original video where he lays out the strategy quite clearly, but here's a brief overview of the setup and the entry criteria now. If you want more detail, be sure to check out his explanation. You'll need 3 indicators for this strategy. First, add the Stochastic RSI with the default settings as seen here. Then add the Trade Pro rejection zone indicator, changing the settings to a 50 EMA and a 200 EMA. And then finally add the ATR Stop Loss finder by the author verified. The settings for this indicator are length 14, smoothing EMA, multiplier 0.7, and leaving unchanged the defaults source 1 high and source 2 low. Also get rid of the price lines. And personally, I changed the style to crosses just for ease of use, and I unchecked tables. The strategy begins with a simple trend determination. If the 50 EMA is above the 200, you're looking for longs, and if the 50 EMA is below the 200, you can only short. For a long trade, the price must pull back to the 50 and close below it. At the same time, the Stochastic RSI K line, that's the one in blue, falls below the 20 level. Now you watch for a cross back up over the D line, that's the orange one, and then another cross back down. Your signal is any second cross up of the blue line over the orange line at a level higher than the first cross. I'll try to make it clear here in the picture. But price can do whatever it wants before that happens. It can go back above the 50 EMA or it can even go below the 200. As long as there's a higher cross when it turns back north, that's your signal to go long. In the original video, Eric enters immediately on the close of the bar, but our rules specify stop entry orders just beyond signal bars, allowing us to get swept into the market on a breakout. So in this case, we set our entry just above the signal bar on its close with a stop loss set at the ATR Stop Loss indicator, targeting 1-to-1 to move your stop to break even, and then 1-to-2 to take full profit. For the short entry, when the 50 EMA is below the 200, we look for a pullback candle closing above the 50 EMA at the same time the blue K line rises above 80 on the Stochastic RSI. Then we watch for the blue line to cross down below the orange line, followed by another cross back up. When a second cross down happens below the level of the first cross, that's our signal bar. Set your stop entry order below the signal bar, stop loss at the ATR Stop Loss indicator, targeting first 1-to-1, then 1-to-2 to exit in profit. It also doesn't matter where that second cross happens, so long as the Stochastic RSI lines don't pass into the opposite extreme region. You know, the 20 oversold or the 80 overbought areas completely across the indicator. but it can be pretty close, so long as the second cross is higher than the first for longs and lower than the first for shorts. Okay, now that we've got our strategy laid out, we can pick the markets and time frames to test using our randomizer spreadsheet. It's 32 markets and 12 time frames that we mix and match. Here are the selections for today's 200 signal backtest, and now I'll be back in 10 seconds with the result. Well, we didn't get even close to the same results as TradePro. He had a 58% win rate and a 74% gain on the account, while I found a 52% win rate and just a 10.5% profit per 100 trades. Why the discrepancy? Well, there were a few differences in our testing. First, as he noted, he performed his backtest only on a single market, in this case Bitcoin, and only on the 15-minute time frame. He also tested just 100 signals, while we tested double that. Additionally, his test entered on the close of the bar, while we always enter with stop orders. Also, our rules require that we compound our winnings and losses, while his trades were not compounded. And lastly, we always move the stop to break even at 1-to-1, and Eric doesn't typically do that unless it's specified by the strategy. Still though, it is a profitable strategy, shown here in this lumpy equity curve, and here on our ranking spreadsheet. It falls somewhere in the middle of the pack in our rankings to date. Interestingly, we did find a similar frequency of signals. The TradePro test took 55 days on a 15-minute chart, making the candles between his signals about 53, and in our test, the candles between signals was 57. So it seems there probably wasn't a difference in the way we identified the trades. In any event, it's an okay strategy according to our testing, but we've done much better here on this channel already. Our highest ranking strategy, the 200 EMA MACD cross, which was the winner of our 5-strategy MACD battle, remains unbeaten with a nearly 32% gain over 100 trades. I'll leave a link to that video on the end screen in just a second. In the meantime, please continue to send me your favorite strategies to test, either in the comments below or by email. In fact, next week I'll be testing one of your suggestions along with a small modification of my own, so please subscribe so you won't miss it. Sincere thanks, as always, for watching, and I wish you a great trading week.